Think Realty Nation, what's up? It's Abhi Golhar. Welcome to the Think Realty podcast. It's going to be a really awesome show for you today. We're talking about how do you become a passive investor, right? It's one thing to be an active investor all the time in the business, pulling your hair out. You know what I'm talking about, right? You've been there. I've been there. You see this receding hairline? It used to be, it's all the way back here now. It used to be right at about here, and I used to have a full head of hair. I don't even have that anymore. But that's because I was an active investor in my own world, and I realized I was building a job and not building a business. And so that's a major challenge for a lot of investors. So Travis Watts from Ashcroft Capital will be joining us momentarily to talk about his journey with real estate investing and what he did to transition from active investing to passive investing. And my strong recommendation and encouraging you to consider doing the same thing. So you actually end up having a full head of hair when you're 60 and not bald like me. It's like right. If anybody has any tips for Rogaine or anything, I'm all ears. So you want to get in touch, you can find me anywhere online at Abhi Golhar. All right. This podcast and this show is not possible without the help of our sponsors. Today's sponsor is Residential Capital Partners, a leading hard money lender with a national scope and a local presence in each market they serve. Their partners and loan affiliates have flipped over 1,000 properties themselves, which means they know your business. Visit them today at residentialcapitalpartners.com. So here's the deal for today. We're talking with Travis from Ashcroft, and then we'll talk about the 2020 hottest housing markets and where they're coming from, and what Zillow, in this case, what Zillow's thinking about California. So I'm excited to discover this with you. Travis, welcome to the show.
Hey, thanks so much for having me. You are speaking my language.
Hey, man, I was reading, so I have notes, right? And I hold on, there we go, notes. And I was just reading, I'm like, this is going to be fun because I feel you on this. I feel the entire active to passive investing model and how that's going to kind of come together. So before we get into all that fun stuff, give us a little background on who you are and what you do.
Sure. Yeah. So basically my story kind of starts like a lot of folks in real estate. In that 2009, I got started in single family homes. It's all I knew at the time. I had a few family members that were quote unquote real estate investors. And, it was just basically buying a home in your own backyard. As many of you know, that was a great time to get started. Somewhat on purpose, somewhat coincidence and luck. I knew I wanted to be an investor. I knew I wanted passive income. I had read, again, like a lot of folks, Robert Kiyosaki's books and Rich Dad Prophecy and Cash Flow Quadrant and all this kind of stuff. So I had made a decision early on in life. I've always been an avid reader, and to have passive income and to be an investor. I just didn't know how I wanted to approach that. I had read a couple books that scared the crap out of me about the stock market. And early on, that's where I had everything because I didn't know what else to do with it. So long story short, right before the big downturn, after reading those books, they didn't give me any specific advice like to sell or when this whole thing was going to have a meltdown. But I just decided to sell anyway and go into cash and self-study until I figured it out. That happened to be the Great Recession. And then in 2009, I decided that real estate was the avenue I wanted to take. From there, I did all kinds of active strategies, man. I really burned myself out. I did, I bought my own house. I did house hacking. I rented spare bedrooms. I fixed and flipped homes. I had some buy and holds. I got into vacation rentals later and just story after story on top of working in the oil industry. And the job I had was a consistent 98 hours per week. It was 14-hour days,
so
7 days a week.
So how does that even break down? So 100 hours a week divided by 5. So you're really looking at 18, 19 hours a day, right? 20 hours a day.
So it's actually 7 days a week. So you did have days off, but fair. It was, 14 times 7. So basically, I had no time, right? That was literally my life was dedicated to that work. And then on the side, I'm trying to scale a single family portfolio that I'm self-managing. And, and every property that I stack on top, I'm just thinking, man, it was the opposite of seeing the light at the tunnel, right? It was closing in and getting darker. And I'm like, man, I don't know how. I had ambitions to go to 50 or 100 homes, and I'm like, I didn't see a way out. I tried property management, I tried different avenues, but at the end of the day, I went back to the drawing board. I discovered apartment syndications. I discovered being a passive investor, not just in syndications. That's mostly what I do, but in other avenues as well. And that's the approach I took. I was so burned out. I was
Yeah.
so like you alluded to. Not that I lost a lot of hair, but it.
Yeah, no, you look
it was.
great. You look great. Just be worried for me. Like that's, yeah, it helped me take some of your passive income and like put it to like a medical research fund for receding hairline symptoms. That would be helpful.
Awesome. So yeah, I mean, that's kind of how it evolved. Somewhere around, it was about 2015 or so. So from '09 to 2015 was all single family stuff. And then 2015 through present, all syndication, all completely passive, hands-off approach. Love real estate, love the real estate strategies. I do the same types of stuff I always did. I don't actually do anything, just send in some money to invest. So that's kind of what the story is. Ashcroft Capital came along through this process. Basically, when I reached the financial independence number that I had in my head, which meant I had more passive income than I had living expenses, I quit the oil field job. I hated that job. I wanted more freedom in life. I wanted to pursue things that I was passionate about, that I could learn from. So I went to go work for some brokerage firms, and I wanted to learn the Wall Street stuff. I wanted to learn stocks, bonds, and mutual funds. I thought that would really help me along my journey. Turns out it didn't. And that wasn't something that I really wanted to pursue. But again, I had the freedom and the flexibility that passive income brought to be able just to up and quit and shift gears and go down a different path. And so I basically today, I'm a big investor with Ashcroft Capital. I do some live events with them, and I get, the privilege to speak with, hundreds, if not thousands of investors just about syndication, about passive income and how this stuff works and the pros and the cons, all that kind of stuff. So that kind of brings us through today.
Yeah, I love it, man. I mean, that's a truly powerful story, super inspirational. Congratulations on your success so far. And it's hard to sometimes get there, right? It's hard even for business owners to take themselves out of the equation and say, I'm going to do a founderectomy, right? It's like, all right, you've had the founders in, or you've founded your own business, and now it's time to get you out. And it's hard. It's hard to go through that exercise because you realize that you are the center of attention for your business. You're so tied to your business that you are the lifeblood facilitator, I guess, for that opportunity that you're working on. In your case, it was a job, and you were tied to that 98 hours for 7 days. That's tough. And even if you think you're running a business, you're probably not running a business, right? You're running your job. You're running yourself into a job, into the ground. And you have no idea what passive income even means. And to have that time freedom to learn about opportunities, those such as Ashcroft Capital, it can be a little time consuming. And it can be really intimidating. It can be scary. And you think, well, how am I ever going to find financial success? Even though I'm running a 6 or 7 figure a year business. I know plenty of entrepreneurs. They're running high 6 figures, low 7 figures, mid 7 figures, 8 figure businesses. Their profit margins are 1, 2, maybe 5, 10%, if that. That's not a business, right?
Yeah.
That's it's like death on a stick. So when it comes to you enjoy multifamily syndication, and you also were in the single family space. What was the transition point for you? Do you still own any single family? Or did you get rid of all that and now you own multifamily, or you're part of an LP or a GP position on the multifamily side? Maybe help me understand that a little bit.
Yeah, exactly. So I really was an example of one of those folks that kind of hit rock bottom. I got so burned out. I was so frustrated. I had everything in my head from just quit real estate, go back to the stock market. It's not working, all these negative thoughts to, obviously there's some people doing this successfully, and what are they doing? And how can you be passive? That has to be achievable. It has to be. So long story short, it was self-education that got me through it. It was self-education that got me over the hurdle. It was reading books. It was going to local real estate meetups. It was finding numerous mentors, that were willing to kind of explain this stuff to me, on a free basis. And so for me, I had a big enough why. I really did not like my job. I really wanted to do away with that. I really didn't want to be in the business of real estate. I didn't enjoy managing tenants. I didn't enjoy doing leases. I didn't enjoy dealing with, attorneys and starting up LLCs and having 100 bank accounts and, all these different things that were just frustrated and losing my write-off receipts. And the whole thing was just too much for me at the time with what little, I had to spare in time. So I made the leap kind of half in faith. I hope this works, and half, like I said, through self-education, and kind of, I saw the light at the end of the tunnel finally. And it was, this is something that's going to be scalable for me, whether I have one investment in a syndication or I have 100, it's going to remain completely passive. It's not going to take my time. And even today, I fully intend, I'm a full-time limited partner investor. I don't intend on doing my own deals. I don't intend on being a general partner. I don't want the time commitment.
Yep.
And again, I don't want to be in the business of it. I just enjoy leveraging other people's skills, their business model, their connections. They'll do the legwork. And here I am, just send me the check.
Hey, we're about to be besties, right? Like, that is the exact way that I think about. So in my model, I've got the businesses on the one side and real estate investing on this side. And I love being active in business a little bit, because that, to me, Travis, represents creativity.
Yes.
And like the launch of a business, the process design, technology design, that's my art form. I really get to, I enjoy being able to play in that business, in that world. But real estate investing, I have zero interest in doing my own deals. Like, none. Like, I'll go and buy single family rentals, but that's property management. Then I'm going to hire a business manager for that, right? I don't want to touch it. Don't give it to me. I don't want to pay taxes. Like, I'm not the guy that's going to do any of that stuff. I'm like this ultimate white collar worker, right? Like, that's just me. I don't want to do it. Yeah. But I totally appreciate what you're saying. So from a multifamily perspective, maybe in like a minute or less, help me understand why multifamily.
Yeah, a lot of self-education. So I tend to focus on recession-resistant investing. That's hugely important to me. I know a lot of people will just do like the low-cost index fund in the stock market, and you do one strategy till the day you die, yada yada. But my whole thing on that is like, if you don't have to lose in a downturn, or you can lose a lot less potentially, then why not focus on an asset more like that? Why multifamily? Cash flow, current income. I'm not big on, speculating on maybe there's some equity appreciation coming, or, whatever's on the back end of a deal. I'm focused on what pays out today and what pays out monthly. And that's my income. That's what I live on. And speaking to recessions and whatnot, historically speaking, multifamily held up very well in 08, 09, comparative to a lot of single family, also self-storage, mobile home parks, ATM machine investing. There's a lot of different things that are more recession resistant and not just so subject to the ebbs and flows of the overall market.
I'm with you. And so I live in Atlanta, and the multifamily market in Atlanta has gotten really competitive. Cap rates have like gone through the floor. I mean, it's been really crazy, and I'm sure you've analyzed the market as well. If it's hard to find deals in multifamily, and you have a lot of sponsors, you have a lot of groups now coming in saying, I'm going to be a multifamily investor, do you only stick to the multifamily asset class, or are you also maybe looking at diversifying a little bit within the real estate asset class with other potential ventures? Maybe, I don't know, build to rent, or new construction, or something else, just to kind of hedge your bets a little bit.
Yeah, absolutely. I'm still bullish overall, just from a macro level on multifamily. But yeah, if we see cap rates, let's say in a market like yours, go down to 2%, I'm out. I'm not investing in multifamily at that point. So yeah, I mean, you have to shift and you have to adapt, and that's kind of where that self-education comes into play. And that's why masterminds and seminars and meetups and podcasts and books, I mean, this is where that really pays off, is being able to kind of navigate that path as we go along.
Yeah.
And I'm already diversifying. I have been for some time. I alluded to a couple things there, like ATM investing, distressed debt, first lien notes. There's a handful of things that I'm investing in outside multifamily. And I'm not completely anti single family. It's just going to depend on how much involvement that's going to
That's
require
right.
versus what kind of returns versus what market we're talking about, what kind of deal. It's always a deal to be had. I mean,
Yep.
if you found a deal in your market for, $30,000 and it was a great house, well, yeah, I'd buy it.
Yep.
I'm not just opposed to that, just to be opposed to it. So
Right.
yeah,
It's funny that you say $30,000 is the number. I just finished interviewing a gentleman from St. Louis, and he's like, "Well, you can buy a $30,000 property here, and it'll cash flow, and it'll rent for $900 a month." I'm like, I'm going to bankofamericaonline.com, right? And like bankofamerica.com, and like I'm wiring you $30,000 right now. Like, can we do this? Like that would be such a great yield.
Yeah,
but it's a good point. I mean, as a passive investor, it shifts the way that we think about money, and it shifts the way that we think about opportunity, because I have no interest in running a deal, right? Like, I mean, you and I are very similar. We're both too good looking to like actually be involved in a deal, right? Like, just here's my money and just give me a return so I can go, like hit the beach and just kind of chill for a little while until the next deal comes along. So I'm with you. I'm with you 100%. Listen, Travis, I mean, I appreciate the story. We talk about time freedom. We talk about the transition between active investing to passive investing, multifamily, single family. We covered a lot in a very short amount of time. If I want to engage, let's say you get to learn about your story a little more, or understand maybe what opportunities Ashcroft is taking a look at and some of the market trends that you guys are paying attention to, how do I get in touch?
Yeah, two different things. One, email is always the best for me. So my email is travis@ashcroftcapital.com. Also, I have a free passive investor resource guide. A lot of the stuff that we just talked about, how to vet a sponsor, how to vet a market, terminology. If you're kind of new to this space or considering it, definitely download that guide. That's at ashcroftcapital.com/passive investor. I'm also on Bigger Pockets, LinkedIn, Facebook, Instagram. So definitely reach out. I help people in any way that I can, even if you want to connect with me and talk about house hacking, renting spare bedrooms, whatever. If I've done it and I can add some value, I'll do it. And so that's kind of how I fill my days up, is, mostly focused on passive investing and syndications, but anything in the real estate realm I've done, happy to share.
Awesome. I appreciate it. And the other two questions I have for you: one, where do you get your ties? And two, what kind of hair gel do you use?
Everything I buy is pretty much on Amazon. So, might as well sponsor this with Amazon.
Yeah, there you go, right? Like, where's the logo? I don't know. It's somewhere. Travis, I appreciate the time. I'm going to be in touch about the ATM idea. I think that's kind of cool. We're very similar in that sense from a diversification perspective, but also taking a look at opportunities that are outside of multifamily and outside of single family that still have a pretty high yield. So we'll certainly be in touch, and that's Travis at Ashford Capital, ashfordcapital.com?
Ashcroft.
I'm sorry,
Capital.
not Ashford, ashcroftcapital.com. That's right.
You got it.
Ashcroftcapital.com, ASHCROFT capital.com.
You got it.
Cool. Travis, thanks for your time, man. I appreciate it.
Thank you. Appreciate it.
You got it. This next segment is brought to you by Norada Real Estate Investments, your premier source for cash flow investment property. You can visit them at www.turnkeyrealestateInvestments.com. Let's breeze through this one real quick. So Zillow just put out a press release titled 2020's hottest housing markets will come from the South, while California sees a cool down. Of course, California is going to see a cool down. I have a really good family friend, who's thinking about moving to California. I'm like, watch out. Shut the front door, right? Like, don't move to California. Take my word for it. So this article is very interesting. Quote, Austin's housing market is expected to outperform the national average. But what's funny is you take a look at some of these primary markets that are outperforming other primary markets and just other markets nationally. That's not going to be the case in the next year and a half or two when we do see a little bit of that correction. Those folks in the primary market that have been really seeing some good gains and good yields may also be hurting a little bit when we start to see that downturn. So be very mindful of that. Let's see, Atlanta. All right, so this is Zillow.mediaroom.com. This is where you'll find that press release. It says Atlanta, for example, 63% of those surveyed expect Atlanta to outperform the national average. Same with Austin, Charlotte, Cincinnati. So Atlanta's 63%, Austin's 83%, Charlotte 59%, Cincinnati 12%, Columbus, Ohio 21%. This is a very, very interesting article. And these panelists, there were about 110 panelists that Zillow surveyed here. And these panelists are most optimistic about the fact that Austin, Charlotte, Atlanta, Nashville will continue to outperform the national market. And these panelists are also pessimistic about the most expensive California markets, such as, start guessing, San Francisco, right? San Jose, Los Angeles. And why? Because $1 million is going to get you a square foot in downtown LA, where you can go to St. Louis and buy a piece of property for $30,000 and rent it out for $900,000. And even if 50% of that is your expense load, you're still coming out pretty well ahead, right? So start to take a look at some of these other markets and some of these opportunities that exist outside of your primary market. If you live in Indy, perfect, right? Like, Indy's a great market. If you take a look at Indy in 2008, it was very stable. Atlanta, whoop, boom, right? Like Detroit, whoop, boom. It's crazy. So start paying attention to some of these ideas and some of these data points. John Burns has a fantastic report that you can download by going to, I think, the realestateconsulting.com, so check him out. And then once you find your strategy and you understand your investing personality, get in touch with the Ashcroft team and see what makes sense. And that's ashcroftcapital.com. All right, we got to go. I had fun. This was fun. We need more personal stories. So I'm going to make that a point. We're going to do that. We can't do this podcast without the support and love and awesomeness from our sponsors. The sponsor today is Residential Capital Partners, a leading hard money lender with a national scope and local presence in each market they serve. Their partners and loan affiliates have flipped well over 1,000 properties themselves, which means that they really know your business. Visit them today at residentialcapitalpartners.com. All right, I'm looking at my notes. I don't have anything else for you guys. That's a wrap. You want to get in touch with me? You can do it anywhere online at Abi Golhar, Instagram and LinkedIn. Those are my two favorite platforms right now. I tried TikTok and said, nope, I'm not 16 years old, so I'm not ready for TikTok yet. I'm going to kind of put that on the back burner. But LinkedIn, Instagram, Facebook, and you know where to find me. Think Realty Nation. Until next time, happy investing.